Hello everyone and welcome to the UK LCA Assessor Foundation Training Programme, a collaboration between CIBSE Training, Construction Carbon and the Supply Chain Sustainability School. Today we cover Module 6 of the e-learning modules. Module 6 is going to cover the wider case for sustainable construction. This module is presented by myself, Leonardo Poli, LCA advocate at One Click LCA, and the module has been written by Simon Sturgis of Targeting Zero and Introba. The aims of this module is to provide future life cycle assessors with an appreciation of the full range of implications associated with sustainable construction from an environmental, economic, and social perspective. This module explains the economic and business benefits of building sustainably, with an overview of sustainability beyond carbon. In this presentation, we're going to first cover definitions and a brief overview of key sustainability concepts. We're then going to go through economic and business aspects related to sustainable construction, and finally, sustainability beyond carbon. Let's start with Section 1, Introduction to Definitions and Key Sustainability Concepts. Before starting, it would be useful to introduce the concept of triple bottom line. The triple bottom line is a business concept that includes people, planet, and profit. In 1994, an entrepreneur called John Elkington introduced it as an accounting framework, in the hope of moving away from financial accounting-focused business system towards a more comprehensive approach. Elkington believes that in order to get an accurate appreciation of business performance, organizations should go beyond what is reflected in their profit and loss statement and fully account for all costs associated with doing business, which of course includes the people and the planet. The people includes all stakeholders, so employees, local community, as well as members of the wider company supply chain. This is another differentiator from traditional business making, which would normally focus on shareholders. And then we have planet, on the other hand, which indicates the implication of the natural landscape in which the business operates. This brings us to the UN definition of sustainable development, which is sustainable development is development that meets the need of the present without compromising the ability of future generations to meet their own needs. Hence the word sustainably, which does not carry an environmental meaning per se, but rather is the result of the combined action of three pillars of economic growth, social inclusion, and economical protection. All three are related to one another and crucial for the prospering of individuals and societies. An example of how the environment and economics are related is climate change, which can cause extreme weather events, which has recently reduced the availability of some fruit and vegetables in the UK supply chain. This, in turn, can drive up inflation. In this slide, we can see a breakdown of some of the environmental, social, and economic aspects associated with construction within the execution and operation phases, and how they influence one another. The donut is a visual framework for sustainable development that combines the concept of planetary boundaries with the complementary social boundaries. It is named after the shape of the diagram, so a disc with a hole in the middle. The donut consists of two concentric rings. The inner ring is the social foundations, which ensures that no one is left falling short on life essentials, whereas the outer ring is the economical ceiling that ensures that humanity does not overshoot the planetary boundaries that support ecosystems. Sustainable growth happens inside the donut within the inner area in the middle between the two circles. The goal of donut economic is not GDP growth, but enabling the donut to thrive. A regenerative world view sees the Earth as a living system made up of nested entities. Within this system, everything is interconnected, and what affects one part of the system also affects the other parts. Every form of life benefits the system within which it is embedded, and it receives benefits from the system in return. Entities are capable of regeneration only as a part of a larger value-adding process. Below is a definition of sustainability from a living systems worldview. The definition is to make the world work for 100% humanity in the shortest possible time through spontaneous cooperation without ecological offense or the disadvantage of anyone. In traditional mechanistic worldview, humans stand apart from the environment and manipulate natural resources to achieve objectives set by themselves. This view is focused on achieving analytical targets, maximizing the efficiency of operations, and problem solving within the accepted boundaries, with the overarching goal to minimize damage to the planet. On the other hand, regenerative view implies understanding the Earth's pattern and aligning with them. This concept is based on the idea that humans are an essential part of the living system, and as such, they can make a positive contribution to it. In modern days, a sustainable business model can be defined as a business model that creates, delivers, and captures value for all its stakeholders without depleting the natural, economic, and social capital it relies on. So going back to the UN definition of sustainability again, modern economics theory implies that a business model is to be deemed sustainable when it creates value for all its stakeholders without causing damage to the people and the planet involved. Moving on to section number 2. And in this section, we're going to go into the details of one of 3 pillars, the economics. I'm going to outline a series of implications, positive or negative, that sustainable building has on economic and financial performance of the business doing it. The world of economics, which all our clients inhabit, has a range of financial sustainability organizations and metrics that aim to ensure that climate change is integral to financial and investment decision making. This can be about reducing investment risk, either by choosing to fund projects that are, for example, outside areas of potential flooding, or more proactively by funding projects that demonstrate particular sustainability credentials. There are several relevant global organizations that provide guidance to invest, fund managers, and bank linking climate change and investment. The United Nations, or UN, as a result of the Paris Agreement of 2015, is unsurprisingly a leader in this. The 2015 Paris Agreement on Climate Change, or COP21, under the auspices of the United Nations, committed national governments to reducing carbon emissions with the goal of keeping the temperature rises to well below 2 degrees and to pursue efforts to limit the temperature increase to 1.5 degrees above pre-industrial levels. To achieve this means that stakeholders in all sectors of the global economy will need to significantly reduce carbon emissions to ensure a transfer to low carbon economy. A number of national governments are already implementing legislation to ensure that Paris commitments are met. In the next slide, we're going to introduce a set of organizations that are relevant to both the international and UK national economic background to climate-related decision-making. This is not an exhaustive list, but it provides an introduction to the ecosystem of economically influential organizations. So the United Nations has published the Sustainable Development Goals, which provides a framework for implementing the Paris Agreement. These set out the key issues for sustainable development and are used by an increasing number of real estate developers and infrastructure client bodies as a reference point for good development. These 17 Sustainable Development Goals are not specifically carbon emissions oriented and cover the whole range of criteria considered to be relevant to sustainable development. The IPCC was created to provide policymakers with regular scientific assessment on climate change, and its implications and potential future risks, as well as to put forward adaptation and mitigation options. Through its assessments, the IPCC determines the state of knowledge on climate change. It identifies where there is agreement in the scientific community on topics related to climate change and where further research is needed. The reports are drafted and reviewed in several stages, thus guaranteeing objectivity and transparency. The IPCC produces regular reports which are influential globally and are taken into consideration by the UN and international banking and investment organizations. The Financial Stability Board, or FSB, is an international body that monitors and makes recommendations about the stability of the global financial system. The FSB is essentially a club of the world's central banks. This includes Bank of England, Bank of France, the US Federal Reserve, and it promotes internal financial stability. It does so by coordinating national financial authorities and internal standard-setting bodies as they work towards developing strong regulatory, supervisory, and other financial sector policies. It fosters a level playing field by encouraging coherent interpretation of these policies across sectors and jurisdictions. To help identify the information needed by investors, lenders, and insurers underwriters to appropriately assess the price climate related risk and opportunities, the FSB established an industry-led task force, the Task Force on Climate-Related Financial Disclosure, or TCFD. The task force was asked to develop voluntary, consistent climate-related financial disclosures that would be useful to investors, lenders, and insurance underwriters in understanding the material risks. The TCFD is increasingly influential as it directly influences, for example, the Bank of England, who in turn have oversight across the UK financial community, influencing banking and lending across the UK. The TCFD has had a particularly strong impact in raising the issue of climate change as a significant investment and insurance issues with attendance, risk, and opportunities. This has raised the awareness of climate change as a risk issue with respect to property investment. The Principles for Responsible Investment initiative was launched in 2006 by the UN Secretary General Kofi Annan, who invited a group of the world's largest institutional investors to join a process to develop the principles. It currently has approximately 3,750 signatories globally. That was updated in 2023. It has 6 key principles that link investment to climate change mitigations. Its main principles are as follows. Principle number 1, we will incorporate environmental and social governance, or ESG, issues into investment analysis and decision-making processes. Principle number 2, we will be active owners and incorporate ESG issues into our ownership policies and practices. Principle number 4, we will seek appropriate disclosure of ESG issues by the entities in which we invest. Principle number 4, we will promote acceptance and implementation of the principles within the investment industry. Principle number 5, we will work together to enhance our effectiveness in implementing the principles. Finally, principle number 6, we will each report on our activities and progress towards implementing the principles. In addition, the following general principles relate to real estate. Fiduciary duty. So as part of a wider effort to implement the Paris Agreement, every real estate asset owner, investor, and stakeholder must now recognize they have a clear fiduciary duty on understand and actively manage ESG and climate-related risks as a routine component of the business thinking, practices, and management processes. Another general principle related to real estate is the long-term performance, which is Failure to actively address these risks will not only hinder global efforts to address the climate challenge, but will also hurt long-term returns, undermine economic stability, and reduce the caliber of the infrastructure passed to the future generations. GRESB or GRESB is a local standard for ESG benchmarking and reporting for listed property companies, private property funds, developers, and investors that invest directly in real estate. The assessment evaluates performance against 7 sustainability aspects and contains approximately 50 indicators. GRESB does not currently require reporting on embodied or whole life carbon, but does have significant coverage with respect to operational energy use. Each indicator is allocated to one of the 3 ESG dimensions. So E, indicators related to actions and efficiency measures undertaken in order to monitor and decrease the environmental footprint of the portfolio. S, indicators related to the entity's relationship with an impact on its stakeholders and direct social impact of its activities. And then G, indicators related to the governance of ESG policies and procedures and approach. The Carbon Risk Real Estate Monitor, or CREAM, exists to promote retrofit and reduction of greenhouse gas emissions from the poor energy efficiency of existing buildings and the still too low refurbishment rates. The EU intends to decarbonize the building sector by 2050. The reduction of the EU carbon footprint requires a significant increase in energetic retrofits in the existing property stock. CREAM aims at supporting the industry to tackle these risks and foster investment in energy efficiency, as many assets will become stranded properties that will not meet future energy efficiency standards and whose energy update will not be financially viable. The Bank of England is carrying out ongoing work to embed climate change into financial decisions and microeconomic analysis. The diagram illustrates the program for this. Why? Because climate change and society's response to it represents risk relevant to financial objectives. The bank's response to climate change is motivated by its statutory objectives. The first involves promoting safety and soundness by enhancing the prudential regulatory authorities' approach to supervising the financial risk from climate change. The second involves enhancing the resilience of the UK financial system by supporting an orderly market transition to low-carbon economy. The bank is an official supporter of the TCFD recommendations. In November 2020, the bank, alongside others in the joint UK government regulator TFCD task force, set out a roadmap towards mandatory TCFD-aligned climate disclosure across the UK economy by 2025. In October 2021, the government set out more information on their proposed Sustainability Disclosure Requirements, or SDR, in their Sustainable Finance Roadmap. The SDR will provide an economic-wide framework to support the greening of the UK financial system and alignment with the UK's net zero commitment. It will cover UK corporates, investment products and investment portfolios, and will streamline the UK's existing disclosure requirements, e.g. mandatory TCFD-aligned climate disclosures with new requirements. At an international level, the bank supports the International Sustainability Standard Boards, or ISSB. The ISSB work is to develop a global climate reporting standard. When the IFRS Foundation on establishing a Sustainability Standard Board in November 2020, the bank publicly supported the proposal and recommended that future global sustainability standards should build on the TCFD framework and recommendations to promote global consistency. The bank continues to actively engage with the ISSB to support their work on climate disclosure. So the key pieces of UK legislation relating to climate change are the Climate Change Act of 2008, its adaptation by the UK government in 2019 for the UK economy to achieve net zero by 2050, and the Act's further adaptation in 2021 to achieve 78% carbon reductions by 2035 compared to 1990, and the further commitment at COP26 in Glasgow to achieve 68% carbon reductions in the UK economy by 2030. These commitments are all essentially the same. However, they do emphasize the importance and urgency of reductions across economy, including the built environment industry, by providing interim targets. So the combination of the above UK commitments over a period from 2019 to 2021 shows strong political and legal commitments by the UK government to reduce carbon emissions across the UK economy by providing a clear downwards trajectory for carbon emissions for the UK economy to achieving net zero by 2050 with clear interim milestones. Although this act is unclear on the overall UK requirements, there is not a great amount of regulation with respect to actual delivery for the built environment industry. Before moving on, you're almost halfway through this module, so this is a good point to take a break. So feel free to pause the video, grab a glass of water, or take 5 minutes. Moving on to section number 3, the business case for sustainable construction. So the economic context in which developers work, as described in section 2, is not a guarantee that they will adopt low carbon principles for their developments. There needs to be a solid business case to enable assessors to help developers of buildings or infrastructure understand the benefit to them of a low carbon strategy. These are the benefits, and we're going to go through these individually now. Starting with value engineering. A whole life carbon assessment, or WLCA, is an activity is very much aligned with value engineering, as resource efficiency is fundamental to low carbon design and construction. Whole life carbon assessment helps ensure that all material and product use is optimized. Resource efficiency in turn supports financial efficiency. Number 2 is the long-term durability. A whole life carbon assessment will, through examining the in-use phase of the life cycle, will assess the maintenance, repair, and replacement cycles associated with the finished asset. Assuming the design is carefully evaluated to minimize lifetime carbon emissions, the assessor should check to ensure that products and systems are chosen to minimize maintenance, repair, and replacement. The assessment will therefore proactively encourage good design, detailing, and assembly to ensure that lifetime resource use is as efficient as possible. For a client, this translates into reduced maintenance and energy cost for them and or the occupier. For more information, you can see the BISRIA soft landings approach. Moving on to number 3, which is carbon cost and benefit optimization. Part of a whole life carbon assessment will be to examine the relationship between embodied carbon cost, for example, insulation, and operational carbon benefits, for example, the associated reduced energy use. By assessing these in parallel, it's possible to optimize this relationship between them. This can result in a more efficient building overall, which will produce financial benefits either at the outset or over a building's life cycle. Then we have due diligence. When purchasing an existing building or asset, a whole life carbon assessment is evidence that the building lifetime performance has been evaluated. It gives a potential purchaser confidence in the overall carbon performance of the asset, and also that maintenance, repair, and replacement have been considered in detail along both the design and construction phases. Moving on to marketing. The public is increasingly aware of carbon emissions through both the press and in particular the purchase of cars or flights. Both now typically identify the carbon emissions associated with individual purchases. The ability to market homes or office spaces in a similar way by using kilograms of CO2 equivalent per meter square as a metric alongside reduced energy use can now provide marketing advantage, leading to quicker sales and or improved value. Research from the EON Energy has found that 80% of its first-time buyers within the millennial and Gen Z generations are willing to pay more for properties with greener energy systems. Then we have future-proofing asset value. All the benefits itemized in this part 2 continue to underwrite the future value of constructed assets. However, the reverse is also starting to apply, i.e. the substandard asset will reduce in value potentially to the point they become stranded asset, at which point either a major refurbishment or demolition will be necessary. Future-proofing asset value will also include taking actions to preempt expected changes in regulations, for example, Part Z, thus preventing early obsolescence. Whilst currently there may be a rental premium for buildings that are sustainable, the idea of a green premium may diminish as more buildings become sustainable or meet net zero carbon goals. Instead, what is already starting to emerge is the converse principle of the brown discount. This is where an asset does not meet current environmental standards or net zero requirements, leading to reduced rent and value. The 2022 RICS Sustainability Report suggests that brown discount is perceived as 10% on average across real estate professionals globally, although this can reach up to 30%. Performing a whole life carbon assessment that includes lease cycles in addition to maintenance and replacement cycles can remove a significant risk element for asset owners. Furthermore, consideration of future climate scenarios can help ensure that the asset is capable of withstanding future weather conditions. Incorporating design requirements for future climate conditions into current design supports a positive building performance throughout the entire life cycle and reduces costs related to climate adaptation. Future-proofing asset value, regulatory and policy. Preempting expected changes in regulatory will help retain building value into the future. Legislation surrounding climate-related disclosures for the built environment is becoming increasingly more common, with countries potentially introducing a carbon cap within the next decade. In Europe, the EU Green Deal mandates no net emissions of greenhouse gases by 2050. In line with the Green Deal, the European Commission will adopt a first set of sustainability reporting standards developed by EFRAG by the 30th of June 2023. This will include requirements for all businesses to report on sustainability metrics, as well as additional disclosure obligations for financial market participants. The EU is also expected to publish a revised strategy for a sustainable built environment in the near future, although when exactly this will happen is unclear. The topic covered in the strategy will include using levels to integrate life cycle assessment in public procurement and the EU Sustainable Finance Framework. The development of a digital logbook for buildings, which will be used to record their sustainability performance over the years. A revision of material recovery targets set in the EU legislation for construction and demolition waste. Potential new targets for carbon reduction and storage. Once again, in the context of European law, in 2020, the European Commission launched the EU taxonomy. The taxonomy is essentially a system used to classify economic activities and establish whether they can be considered environmentally sustainable or not. This system was originally designed to support the Green Deal, and it is aimed at directing investment towards sustainable activities. The EU taxonomy is an EU-wide classification system aimed at directing investment towards sustainable activities. It was designed to support the Green Deal. The EU taxonomy provides company, investors, and policymakers with appropriate definitions for which economic activities can be considered environmentally sustainable. The 6 environmental parameters established in the taxonomy regulation are 1. Climate change mitigation. 2. climate change adaptation. 3. The sustainable use and protection of water and marine resources. 4. Transition to a circular economy. 5. Pollution prevention and control. And 6. The protection and restoration of biodiversity and ecosystems. Businesses need to prove a substantial contribution to at least one of these objectives, while not causing damage to any of the others. To retain building value into the future will mean designing the optimum environmental performance and not just meeting current requirements. In the context of UK regulations of future proofing asset values in the UK, preempting expected changes in regulations, there is also UK evolving regulation to consider. Starting with Part Z, the UK construction industry proposed the Part Z amendment to building regulations, which would complement Part L. If introduced, the amendment would require whole life carbon assessment and compliance with embodied carbon limits for all projects greater than 1,000 meters squares or 10 dwellings. There's another one which is in planning, which is the Greater London Authority. The whole life carbon assessment are mandatory for all referable development proposals, and this includes developments of 150 residential units or more, developments of over 30 meters in height outside of the City of London, and developments on the Green Belt or metropolitan open land. Then we're moving on to increased asset value. From an economic perspective, the built environment represents a significant opportunity and is expected to grow within the next decade. Based on data from the G20 Task Force for the Climate-Related Financial Disclosure, green buildings will represent a 24.7 trillion investment opportunity by 2030. In the context of real estate, recent years have seen a green premium or an increase in value of built assets due to sustainable construction practices. In February 2023, the data analytics company MSCI reported a 26% gap in sale prices between London buildings with sustainability ratings from BREEAM and LEED and those without. In the US, data from the representative body for real estate investment trusts, Narrate, shows that green certified buildings can translate into 31% increase in sales values, 23% higher occupancy rates, and an 8% increase in rental income. REIT collectively owns 3.5 trillion in assets, which means that this data is highly representative of general trends within the United States. Furthermore, global property agent Knight Frank has created its own price model to calculate the contribution of green rating to sales value for prime offices in London, Sydney, and Melbourne. Research found an 8 to 18 price premium for green rated offices compared to those without any sustainability certifications. In central London, it shows a 13% premium on rents and a 10.5% premium on sales prices on BREEAM outstanding and excellent rating buildings. Following responsible construction practices effectively represents an investment, and it can result in higher profits. Total cost of ownership. A whole life carbon assessment can be used to produce cash flow based on expected energy use, repair, and replacement cycles, given a total cost of ownership over a given period. Having a detailed understanding of maintenance and, in particular, replacement cycles can be very beneficial to understanding and minimizing future cash flow. Insurance premium. The ability to demonstrate that a detailed long-term assessment of an aspect of an asset physical performance helps give insurance confidence in the quality of asset and assists negotiations aimed at reducing insurance premiums. However, an economic disadvantage associated with building sustainability can have a negative effect on premiums. Insurance are less likely to provide cover for buildings that carry innovative design features due to an increased risk associated with them. For example, timber frame buildings or structure that use modern method of construction or MMC can be problematic. There is no specific data around how much higher insurance can be, as this depends on the specific insurance company, the contractor's experience, and the insurance data available on the technology. BREEAM or LEED. These sustainability metrics are fully supported by a whole life carbon assessment, so there's no conflict between them. A correctly done whole life carbon assessment will contribute directly to a BREEAM or LEED assessment, although a whole life carbon assessment will provide more comprehensive and detailed carbon related information than either BREEAM 2018 or LEED version 4. Both of these metrics provide a broader understanding of the overall sustainability of an asset. Planning authorities now routinely require an EIA or environmental impact assessment as part of any submission. A full whole life carbon assessment is potentially a key contributor to the environmental impact assessment, and for an increasing number of local authorities, a necessary planning requirement and a useful addition to the BREEAM rating. Then we have environmental, social governance, brand value or ESG value. Increasingly, client organizations are reporting against various ESG metrics such as science-based targets, GRESB, etc. Whole life carbon assessments provide an important contribution to these metrics, demonstrating a detailed engagement with sustainability reporting and help enhance the client ESG image. Research conducted by a Journal of Cleaner Production in September 2022 on various businesses in the construction sector highlights the correlation between strategic sustainability and company brand value. According to the study, construction companies that are perceived as green by the general public are more likely to win tenders, charge more, and increase their overall revenue. And then finally, positive impact on employee well-being, reduced labor costs, reduced physical health risks, and positive impact on mental health. Sustainable business practices reportedly carry positive impacts on well-being of staff. Researchers have demonstrated that occupants respond positively to certain features of sustainable buildings by working more productively, making fewer errors, and being absent less often, thus reducing labor costs. According to a study performed by the US ERI, office buildings that are designed to meet sustainable development goals, particularly in terms of air quality, ventilation, access to daylight, and indoor temperature management, yield an increased employee productivity of up to 16%, a 2.7% increase in logical thinking, and 1 to 2% increase in overall company performance. The GWGBC Beyond the Business Case report highlights a link between better buildings and occupant health across the commercial, public, and residential sector. Specifically, highly performing buildings can reduce physical health risk associated with poor indoor air quality, thermal conditioning, lighting. Risks include fatigue, stress, loss of productivity, and the spread of infectious diseases. Finally, the International Well-Building Institute claims that building can positively impact occupants' mental health through design, technology, and treatment strategies. The final part of this presentation surrounds sustainability beyond carbon, or all the aspects apart from the global warming potential that professionals in construction should consider for a building to be deemed sustainable. So the link between carbon reductions and the existential threat of climate change means that carbon reduction tends to be prioritized over the sustainability metrics. However, assuming that every effort is being made to mitigate the climatic impacts of a project, then it is important to consider the range of other sustainability issues that are beneficial to the planet and to humanity. It is worth noting that typically these other sustainability metrics tend to work in harmony with carbon reducing, and there's a degree of mutual support on benefit. For clients, these other metrics also need to be understood in terms of value to a project. It should be noted that, as mentioned at the start of the presentation, sustainability matters aren't just limited to environmental impacts, but also include social values and economic considerations. The UN Sustainable Development Goals represent a comprehensive framework on all aspects of sustainability. They were agreed upon in 2015 and are based upon the original definition of sustainable development that we covered earlier in the introduction section. There are 17 goals to achieve by 2030 across all nations that are part of the UN, and they cover the three macro areas of environmental, social, and economic sustainability. In a way, the 17 SDGs are relevant to construction, just like to any industry. And they are all interlinked between one another in that three pillars of sustainability are strongly linked to one another. For example, the environment in which a building operates will affect its society or the people that build it and use it, as well as the financial aspects of it and vice versa. One can find a correlation and reciprocal influence virtually across all the SDGs. Here is a bit of a list on all the Sustainable Development Goals, or SDGs, that link directly to climate change or carbon emissions. The World Business Council for Sustainable Development, or WBCSD, is a global CEO-led organization of over 200 leading businesses working together to accelerate the transition to a more sustainable world. They aim to make their member companies more successful and sustainable by focusing on the maximum positive impact for shareholders, the environment, and societies. The member companies come from all business sectors and are major economies, representing a combined revenue of more than $8.5 trillion and with 19 million employees. They specifically reference the circular economy, climate and energy, and redefining values. The WBCSD targets the WBCSD targets the realization of Sustainable Development Goals, so SDGs, through 6 work programs. You can see those in the diagram to achieve systems collaboration. The Construction Innovation Hub sets out an approach of how to value projects using a range of metrics other than just money. They've produced a value toolkit, which is a suite of tools to empower clients and policymakers to make value-based procurement decisions that will result in the environmental, social, and economic outcomes they want. This comes together with the 4 capitals approach. The value toolkit uses the capitals approach as a way of defining value. Whilst the capitals approach may be new for a construction audience, it is familiar to a corporate audience where many construction-related decisions are made. It also aligns with the HM Treasury's Green Book, against which public sector investment decisions are made. The aim of the value toolkit and the 4 capitals approach is to bring the full range of sustainability metrics into the decision-making for construction projects in a structured and comprehensive ways. It also helps clients understand a wider definition of value to the overall betterment of their projects. This diagram illustrates the 4 areas of capital: produced, national, social, and human, that together make up the value toolkit. The value definition and measurement process helps clients to articulate what is important to them, their core values and drivers, From this is produced a unique value profile for a project or program. It enables clients to define what success looks like, both the metrics that should be used to measure successful outcomes and the acceptable performance ranges of those outcomes. Bringing together disparate success factors into value scorecards help to embed value priorities into decision-making, enabling clients to compare very different options and exercise informed choice in deciding how to proceed with a project or program. Science-based targets, or SBT, specify how much and how quickly an individual company needs to reduce its greenhouse gas emissions as a share of the global total, in line with the Paris Agreement goals to limit the global warming to well below 2 degrees. The SBT initiative is a collaboration between the Carbon Disclosure Project, the World Resource Institute, the Worldwide Fund for Nature, and the United Nations Global Compact. Targets are considered science-based if they're in line with what the latest climate science deems necessary to meet the goals of the Paris Agreement, limiting global warming to well below 2 degrees to well below 2 degrees compared to pre-industrial levels, and pursuing efforts to limit warming to 1.5. SBT are gaining increasing traction globally across all corporate sectors, including real estate, both developers and occupiers. As of mid-April 2023, 2,253 global companies have signed up. The key objectives are: 1, increasing innovation; 2, reducing waste and unlocking efficiency; 3, strengthening investor confidence; 4, reducing regulatory risk and uncertainty; and 5, reducing exposure to fluctuating, uncertain energy costs. Another framework that can be used to quantify the impact of construction on the environment is called RECIPE. RECIPE is an impact assessment method that can be used to perform a full LCA. It covers the full range of implications that a construction project has on human health, animal health, and natural landscapes, so not just limited to climate change. It's important to consider the full range of implications that a building has on the environment, as in taking into consideration all 18 indicators that we just mentioned in order to prevent burden shifting. Burden shifting is defined as shifting the environmental burden or simply moving the damage to somewhere else. For example, we could be designing a building that is fully net zero embodied carbon and in operation, but it may contain highly toxic material that may cause cancer to the people using them. Carbon tunnel vision, as the expression suggests, means purely focusing on climate change impacts to comply with regulation linked with those. As mentioned previously, all sustainability metrics are interconnected. For this reason, minimizing climate change impacts or carbon emissions brings about a series of other benefits which are listed in this slide. First one, minimize resource depletion. Carbon reduction emphasizes resources optimization and waste reduction, and therefore contributes to reducing the mining and extraction of virgin resources. The parallel emphasis on the use of renewable resources, for example, timber, as a replacement for non-renewable resources such as steel, also helps minimize resource depletion. Number 2, reuse and recycling. The increasing prevalence of the reuse and recycling of materials and products at both the beginning and at the end of the project lifecycle reduces the use of new or virgin material. It also encourages designing for future reuse to enable the resource-efficient life cycle to continue over several generations of project. Then 3, reduced water, energy, and transport use. By optimizing resource use, it also follows that the energy and water that may be used in the fabrication processes is also reduced, as is the transportation cost of delivering materials and products to site. Then reduced waste. Waste reduction is also a feature of more resource-efficient, low-carbon design. This applies to the initial construction process, but also is buildings are designed for disassembly rather than demolition. Then the waste at the end of life phase will also be significantly reduced. Another important aspect concerning the sustainability of a built asset lies in the social value it generates. The UK Public Social Value Act of 2013. In the UK Public Service Social Value Act of 2013, social value is defined as the financial and non-financial value created by an organization through its day-to-day activities in terms of the well-being of the people involved in it. For construction, the people involved are the local community, building occupants, the building construction team, employees of the construction firm in general, and the wider supply chain. Social value is a broader understanding of value, and it is included in the Construction Innovation Hub scope that we mentioned earlier. Social value moves beyond using money as the main indicator of value, instead, putting the emphasis on engaging people to understand the impact of decisions on their lives. Once again, going back to the triple bottom line concept, we are considering not just environmental aspects, but also the social ones, assuming that economic implications will be largely discussed across any business. The UK Social Value Act defines it as the financial and non-financial value created by an organization through its day-to-day activities in terms of the well-being of the people involved in it. And this is just not limited to the local community or the people living around the building, but also building occupants, the building construction team, and the wider supply chain. A metric used to measure social value impact is pounds of SOVs, or pounds of social value, or SROI, social return on investment. The context in which both these metrics are used in the UK is local regulations. The Hammersmith and Fulham Council was the first one to publish a social value strategy in 2010. For each construction project exceeding £100,000, or at least 10% of that must be invested in social value generating activities, hence the expression. There are a number of ways in which a building can make positive social impacts. If we think of the local community, the first step would be to foster a dialogue with them. Ideally, if there is a certain social issue in the area, for example, lack of employment, or maybe even need to supply electricity at low cost, a developer would work to address this gap within their construction project. Internally, construction company can do the same. It is important to communicate with site workers and employees in general in order to identify any unmet social needs and put appropriate CSER initiatives in place in order to make up for those. For example, if there is a lack of diversity within a building team, a company may put an inclusion strategy in place to identify suitable candidates that fulfill diversity metrics. Finally, when it comes to the wider supply chain, it is important to investigate their social value standards in terms of the way their operations are run and their employees' conditions, as well as their own supply chain. A good idea in this case would be to add social value as a metric during procurement and request potential suppliers for evidence of any social value generated within and beyond their business operations. In the UK, it happens. Social value is a public sector procurement criterion of such importance that how a contractor engages with SV could ultimately be the difference between procurement success and failure. According to a 2022 study by the City UK and BNP Paribas, green financing has increased 10 times from 2012. Global borrowing in the form of green bonds, loan, and equity funding increased from 5.2 billion in 2012 to 540.6 billion in 2021. Private banks such as Lloyds, HSBC, and JP Morgan are now providing finance to specifically target sustainably built assets. Governments and international institutions can also be potential source of green funding. The LIFE program is the EU's funding instrument for the environment and climate action. For the 2021 to 2027 period, the EU has increased the LIFE program funding by 60%, bringing it up to 5.4 billion to support a sustainable cross-industry transaction. In 2022, 168 projects have been approved as part of the LIFE program. 7 of those will facilitate energy renovation of residential properties, while 13 projects will be dedicated to the construction of climate resilience buildings and infrastructure. In the US, numerous sources of funding for green building are available at the national, state, and local levels for residential and commercial developments. These include grants, financing, tax credit, equity for green community enterprise, as well as tax incentives for energy efficient properties. So the aim of this module were to provide future life cycle assessor with an appreciation of the full range of implications associated with sustainable construction from an environmental, economic, and social perspective. This module explains the economic business benefit of building sustainably with an overview of sustainability beyond carbon. First, we cover definitions and brief overview of key sustainability concepts. We then went through economic and business aspects related to sustainable constructions, and finally, we concluded with sustainability beyond carbon. This is the end of Module 6 of 6 of the e-learning modules. This module has been presented by myself, Leonardo Poli, an LCA advocate at OneClick LCA. This module has been written by Simon Sturgis of Targeting Zero and Introba. Thank you for completing this module. To conclude the UK LCA Assessor Foundation Training Program, you will need to register to attend our webinar on a date that works for you. This is a fully live session that includes a Q&A with some of the training authors. The webinar will provide you with a summary of your learnings, which will assist you in completing the course online assessment. Thanks again for taking part, and have a good day.